Now let's turn to Nigeria, where the central bank has set a minimum of a loan-to-deposit ratio for commercial banks. Now the measures are set to spur lending in an effort to further stimulate the economy as the country continues to recover from the 2014 crash in oil price. Well, joining us now, Paul Wallace of Bloomberg News. Paul, what does that exactly mean for the sector?
Hi, Francine. Well, this could have a big impact on the sector. Some of the biggest banks in Nigeria have loan-to-deposit ratios of quite a bit below 60%. So if this goes ahead, as was announced yesterday by the central bank, then they're going to have to up their lending quite substantially. Some of the main banks in Nigeria have seen their shares fall today. Guarantee Trust Bank, Zenith Bank, which are two of the main ones watched by foreign investors, they're down today. And the main reason for that is that they and other banks have made quite substantial profits buying Nigerian government bonds, Naira bonds that yield on average about 14% or something. And if they're restricted from buying these, they're going to have to go into riskier lending to businesses, which some analysts say could cause non-performing loans to rise.
Yeah, so Paul, basically the banks got a letter saying, look, these measures are designed to ramp up growth. I mean, will they have an impact?
Well, they argue that it wouldn't. The central bank has long complained, and Governor Godwin Emefiele has said that banks just sit on these juicy yielding T-bills and government bonds and don't do enough lending to the economy, which is growing very slowly. It's growing at about 2%, 2.5%, which is quite a bit below the rate of population growth. It's an economy that's still not yet fully recovered from the 2014 crash in oil prices. But the banks, they say that what they're doing is just prudent. When they can get yields of 14, 15% on government bonds, that's a lot safer for them. And they say it's a lot safer for the financial system if they do that than massively increase their loan books and start lending to small businesses at rates of 20, 25%.
Yeah, but Paul, so just run us through that. Basically, inflation is running at 11%. So the banks are saying we don't want to lend too much because then my portfolio's risk and this could engender, a financial crisis. I mean, what's the probability of that actually happening?
We're going to have to see. There could be some pushback from banks. There might be some fudging of the numbers so that they end up hitting the ratio, which the central bank has said they need to do by the end of September. We haven't heard anything from the banks or the banking association yet, so we don't quite know what their sort of formal reaction to this will be. The central bank has sort of presented it as a fait accompli. They're not saying that there will be ongoing talks to discuss how this is implemented. They're just saying this is what's happening. The banks they have no choice but to go ahead with it.